Hi, this is Randy Finney with Right Side of the Chart, and this is an early session update for Tuesday, April 29th, 2025. It's 10:27 a.m. Eastern Time, so we're about an hour into the trading day, and let's try to do a quick one here. Yesterday, I went into pretty detailed into various trend indicators and long-term, short-term. So we're just going to do an update on the markets. Nothing has changed since really late last week. Looking for a pullback, looking for red day yesterday. We got it barely, but it was red in the Nasdaq 100. Looking for another red day today, and more downside this week is what I'm looking for. That remains the same. This is ES. I'm just here because I wanted to update this one in case I forget. I haven't updated in a little while. ES is the S&P 500 futures contract, and that's a little wedge right here. A little uptrend line broke down. So you're kind of pinched between support and resistance. There's that primary downtrend line I highlighted recently. We had a breakout. But major resistance, as I talked about. This market just has a blanket, a heavy, wet blanket of resistance overhead. That's not to say it can't get through there. It just would surprise me if it went through there like a hot knife through butter. Anything's possible. This week you've got a lot of the rest, not the rest, but the bulk of the Mag 7 will have finished reporting by Thursday night after the close, Thursday afternoon or evening, and we'll kind of have an idea which way this market wants to go. This breakout I expect to fail. Breakouts that occur with overbought conditions and negative divergence, such as I'm highlighting here, have a much higher rate of failing. So that's what I expect to see the S&P 500 do, and it could very well be the start of the next leg down within a larger bear market, or at least be the catalyst for a tradable pullback. I haven't updated this chart in a while, but you can see the levels still hold true. I could tweak the lines a little bit. I'll do that for you right there. Let's just say right there, minimum 53.4278. What would that be? Let me quantify it for you, give you an idea. Have to draw it that way or move the line. So we'll say it's a little over 4%, I think, if I did that right. So to that level, and obviously quite a bit deeper, almost double that if we come up to this uptrend line right here. Let's talk about the market. We'll get to NQ in a second. Let me do this. Let me toggle over to this post here because this prompted me to do this. The last trade I gave you on Treasuries was a long trade. The whole world was bearish, super bearish on Treasuries at the time, saying, oh, Trump's done it now, and the bond vigilantes and the China's dumping U.S. Treasuries as a retaliation. Our Treasury markets yields are going to go to unsustainable levels, and they will ultimately, I think, but not, that's everybody wanted to sell. Remember, we were short there, the pullback, but then on the 11th of April, I reiterated, we're already long equities, and pointed out the last long trade on Treasury bonds. So we had positive divergences forming here. Remember, divergences are just a condition. And so what you're looking for a reversal here, and highlighted that it offered an objective long entry on any of the bond ETFs. ZN and IEF are your 10-year bonds. TLT and ZB are your 30. Typically, you get more bang for your buck on the 30 years. So that was then. It had us going up here. You can see my uppermost targets there. It's a zone that runs when I have two resistance levels in close proximity. That's what I call a target zone versus a single sold target. So you can see one at 111.119, first target. Second target zone, 111.279 to 112.040. Okay, so that was then. This is now. There's that divergent low right there. And there's my target zone. So all this stuff is kind of stitched together. Follow a gazillion things. I don't do daily updates on everything, but I do when kind of final targets are hit, such as we recently hit in Bitcoin and some other things. That's when I'll give updates, and quite often reverse it. Now, I haven't been long this whole time, but I am now short today for the reasons I stated. And like I said, it's aggressive if you go hard short, if you wait for the uptrend lines. This is CN. I'm just showing you that because that's what I showed you in the April 11th post. The 10-year. 10 years most widely followed by the market. And I already gave you the charts on ZB and TLT, showing you the 30 years at resistance. So that in itself is an objective short entry, coupled with the fact, again, it's resistance, the same thing here on ZN, the 10-year, resistance as well. Who knows? Maybe, I don't think we're not in a big enough uptrend to consider this a head and shoulders pattern, but I'm just putting more weight on the fact that we're at the top of my final target zone there. Anybody interested in trading the 10-year, this is the 10-year IEF via ETF, I'm sorry, or CB, I just showed you. 95.83, you can see we have 1, 2, now 3 reaction highs there. We had some reactions around that level as well. So again, at resistance, overbought right there on the on 60-minute chart, which we're on right now. And I already showed you on the, at least on the futures, we have that negative divergence. Okay, now it is not mere coincidence. Back here, we were bullish and long bonds, expecting bonds to rally. Remember, when bonds rally, yields go down. I'm sure the bobbleheads are talking about that on TV right now, just like when bonds were crashing, yields were spiking. And they were saying that's why the stock market's selling off and all that. And so it stands to logic, if I'm correct here. Now, it's just like the gold and silver trades and the U.S. dollar. Like I said, the U.S. dollar will get the dollar start to rallying where it's support, put out a long trade idea on the dollar, short or short the euro. So if the dollar continues to rally, and it has been so far, it has stopped gold in its tracks. Remember, the dollar hit support. That was all last week's stuff. Showed you the dollar major support, looking for a rally in the dollar, and downside in gold, silver, and GDX. And so far, they're not falling hard, but they stopped going up. They were going vertical. And that's usually the first part of it. It's just like if you throw a rock up in the air, straight up in the air, it's going up, up, up. The rate of ascent then slows for a brief moment in time. It actually just sits there, not going up or not going down. And then the reversal, the momentum starts to go the other way. So my point here is, one day down in bonds might not freak the market out. But if you get some traction going and you start heading to the deeper targets that I laid out for you, I just gave you some pretty conservative targets. And I told you again, it might not be. I know that because I've done this a long time. Everybody wants to talk about gold and the stock market. Those two things are 99% of the comments on the site. Very few people take the obscure, what I call obscure trades, things I do, random commodities, agricultural commodities, and treasury bonds and things like that. Treasury bonds are boring. When was the last time you've been to a cocktail party and a conversation broke out about treasury bonds instead of crypto or Nvidia or the stock market? And so look, if that target's hit, it's only a 1.8% pullback. But again, the way you do that is your downside's limited. Everything is relative to the risk reward. And so because Treasury is inherently low vol, you can take 2, 3, whatever your number is, 4 times what you would take in NQ or QQQ, and it makes a 2% trade. Then it multiplies it out. Let's say you took a 3-time position size, and a 2% move in Treasury bonds is getting the same thing you'd get as a 6% trade on the Nasdaq 100 or S&P 500. That's what I mean by beta adjusting the position sizes. And it cuts both ways, because if you're stopped out, your stop loss in percentage terms is going to be a whole lot smaller. At the end of the day, you'll never go broke having a very large percentage stop on the trade if it's a very small position. It's the dollars that you make or lose that are going to hurt you relative to your overall portfolio size. So hopefully that'll make sense. And hey, I'm just going to go on a tangent real quick. I'm watching on a screen. I have a buy to cover order set here on CL. Remember, we're long nat gas, short crude. They tend to move inversely typically. And so remember, on nat gas, and I'll post an update when it hits. We shorted here on the wedge, or at resistance. I think we shorted right there first. Hit my first target, and as I've covered in the last update, we've been bouncing on it. And I said once T1 goes, that'll open the door, and we'll probably get a quick move down to T2. So we're almost there now. So if you're in this one and you plan to cover any or all your position at T2, then we're coming up on it. Or you can set a stop, lower your stops to protect profits and hold out there for that final target. Sometimes we go right through, especially after a period of consolidation like this. I'll tell you, it's not unusual to go on down through the next target because you've already worked off all of the overbought or oversold, conditions. So the oscillators are right in the middle of the road here. So when we hit T2, if we hit it today, which I suspect, we're not going to be oversold at all. So that increases the odds. This is how I'm very flexible with my trades and sometimes decide to cover and or reverse when a target's hit. If short or vice versa, long, sell, and claim the pullback, or sometimes I opt to sit tight and hold out. And this one I may actually do. I had an order there to cover, but I may just cancel that order, follow it down, in other words, trail it down to protect stops in case we do reverse, do that, then, and that way if a stop is right here, when we get down close to T2, it gives me the potential to go down there to T3 and I can keep lowering that stop, protecting gains. And that's mostly it, guys. I just wanted to kind of tell you that or explain how that, short on Treasury bonds, just like when we were long a couple weeks ago, and we were already long the equity markets before that, and Treasuries continue to fall. I just said that was going to help support, as I showed you again, going back to that post on April 11th, that the stock market trend was still intact. I'm looking for an upside. Yellow arrows are always my primary preferred scenario. And there's that uptrend line, which we gained a perfect pullback to. I said, the yellows are primary. And that should contain any pullback there. That was NQ. And then you can see the green arrows going up here. If we break out above the downtrend line all the way up to about, and we still could get there. That's, what is that, 19,918. I have to look pretty closely. You can expand the chart and see it a little bit better there. 19,918. Pull back, get a little pullback to the trend line. And that was it. There's your pullback to the uptrend line right there, which is that. And then we went on to break out above the downtrend line. Thought we might get checked there. And we did. We got a reaction first, and then we took it out. And now I do quite often have different boards. That was a 60-minute chart like we're looking at here. So there was that golden entry right there, one of the best entries in months, if not years, really, if you look at what... In the 19, these lines may have been tweaked slightly. I'll kind of sharpen my pencil here. We could still make it up there. That was that where I had the arrows going again on that chart right here. 19,918. In this area here where we had this big spike, that big drop. Let me go back to it again. Yeah, that's it. It's roughly, I moved it just a little bit, but that's about right here. So that I could very much see that upside to that target I drew from right there. What is that? That would have been, if it's hit, that was a call for about a 13, because I'm overshooting it there a little bit, about a 13% rally. And again, just a week or so. And again, we have a lot on the economic calendar and earnings calendar this week. If we go a little higher, that target will be that was the max target at the time. And we'll still have, you can see the divergence here. I've been highlighting this divergence has not only not been negated, meaning to be negated, you have to take out and make new highs, and then you no longer have negative divergence. But since this last time I updated here, it's grown even larger. So should we push a little higher? And again, you already have the divergence. So we could reverse today, fall a little shy of that target, or go a little higher. Ultimately, what you want to see, should we get rejected anywhere, and again, we're in right towards the bottom of my bounce target zone on the daily chart. This is micro analysis. This is a 60-minute chart. This is the world of the intraday charts, trying to really hone down and get pretty specific on the targets. But the bigger picture bullish or bearish events will be, remember, we had this symmetrical triangle I highlighted. There was the breakout there. We got the first rejection as expected. Then we broke out. Come back in. If we break down below it, there's the apex of the triangle. So if this happens anytime soon, in other words, you fail this breakout, you come back below this the downtrend line, that's a failed breakout. And if you break below this uptrend line, remember, I had this uptrend line here calling for that reversal there and then the up. it wasn't even a valid trend line when I had it drawn. I was just connecting 2 points. Any 2 points could be connected at random. It takes that third, in my book, it's that third reaction, distinct reaction from a distinct point to make it a confirmed trend line, because again, any 2 points can be connected at random. So it was since confirmed, since that April 11th post when we had it, a little bit above it. Therefore, where I'm going with that, it now makes it valid. So if we break that level, you have dual supports. Any back test of the trend line, quote unquote, with my little air quotes, should be bought up. And if it isn't, then that's a very bearish technical event. It means this breakout right here, this whole thing failed. And likewise, other traders are going to be watching this uptrend line. And if that breaks, then that's going to be bearish too. So that's kind of your bigger picture stuff. And bigger picture also has the bounce target zones right here that I gave you before. And again, nothing's changed. We're at the bottom of it. We got a red day yesterday, and I expect another, this week I expect more downside, whether today's green or not, as long as, again, this is bigger picture. If you are playing the long game, meaning you're going for T7, calling that 50+% drop I'm calling for on the Nasdaq from the highs. We've been swinging it down. This is where this was the area. I said no more shorts, not objective. The odds are skewed to the upside. Risk reward was clearly skewed to the upside. We got it. And the question is how much more. We hit pretty much that back then 16% or so bounce hit that first day. We hit it again, and we're kind of just stalling out here. This was a pretty significant level because we had that biggest gain in 25 years in the Nasdaq right there. Another rejection, another one. We broke out the other day, but this is a little tell for me. I'm a tape reader, an old-fashioned tape reader like Jesse Livermore. It's a dying breed. And most traders now, everything's done by computers, and so I'm reading the tape, and what I'm seeing here when I turn off I can do it this way for you. I turn off all the lines. That was a extremely significant level because it was marked again by a record gain day, and the sellers came in hard as expected. We exited, reversed, and then did it again there, and there's a breakout. Now, normally in a breakout, you have a lot of buyers will step in and the market starts to run. Now, the breakout hasn't failed, but this shows very lackluster. Look at the volume bars. The breakout itself was on low volume. That's a tell right there. You want to see breakouts, long side bullish breakouts should occur at least on 1.5, 1.5 times or greater the average volume. Your broker will give you your average volume. Any broker does, and either 60-day, 90-day, 100-day, something like that. And that one certainly didn't. And so right now the breakout's intact. We're also pinched against the 50-day exponential moving average right there. But most importantly, if we drop now below this level right here, in other words, below Friday's low, Friday's low or last Thursday's high, then the breakout has failed. Okay, so it's going to be bullish. Okay, in keeping with my promise to keep it relatively short, we're under 20 minutes. I'm going to stop it here, get it out to you. Those are the things I'm watching primarily on the equity markets. I hit on crude just because we're coming up to that next target. I'll stop this one here, and Tesla, still shorted Tesla at the 200, still like that. It's one of the few fangs I have as an official trade idea now. And again, that one I didn't even give you near-term targets. If you want the near-term targets later, or anyone's in this, I'll give you some near-term targets. But again, I kind of threw that out there for those that might want to, get what could be a nice short op on Tesla, tuck it away for the next leg down. That's what that trade was all about. All right, I'm going to wrap it up here. This has been Randy Finney with Right Side of the Chart. Have a great day.